So basically, the life insurance policies are set up for a very specific reason. That is that to protect someone who depends upon you from loss, financial loss related to your death. So again, uh, when we talk about life insurance policies, depending upon what type you're talking about, term life, etc., um, the objective, of course, is to live as long as you can, but leave something for other people in the event that of your demise when it actually occurs. Again, different forms coming that are out there, but that's kind of the general idea. So the proceeds can be used to pay off such things as mortgages or other debts at the time of your death, lump sum payments to children reaching a specified age, which are called endowments. So you're setting up funds for whatever reason, education, income, etc., for your children to cover medical expenses, funeral costs, um, accumulate savings or establish income for survivors, make estate and death tax payments, any variety of things that it can be set up for. So again, with life insurance, what we're talking about, the people that are kind of responsible for this are actuaries. They're the ones that good jobs, by the way. They're statisticians, and they look into the economic costs and risks and uncertainty related to paying off that life insurance to the beneficiaries. And they're the ones that come up with such things as, again, mortality tables showing the number of deaths among various age groups and genders during any given year. So they're the people that do the analysis behind this to make sure that, again, the objective of an insurance company is to stay in business, right? It's not to pay the beneficiaries and go broke in the process. It's an ongoing business. So life expectancy, individuals are living longer and due to improved medical care, healthier lifestyles, education obtained in general, and has been the case for quite some time. Women certainly do outlive men, keeping that in mind. So the real question is, do you actually need health insurance? No, life insurance. So in the immediacy, if you're married, if you have children, if you have, parents, for example, or it doesn't matter. The point is that if you have somebody that you're responsible for or feel responsibility for, you certainly, this was in the immediate, you definitely would like to have some insurance set up to protect them in the event of your demise, right, of your passing. So a lot of it depends upon where you're at in the life cycle and the type of household you live in. If you have small children, that's the greatest need for life insurance to safeguard their interest, to ensure that they have a good, solid future, where they're protected financially in the event of your passing. Again, so looking at the objectives, how much money do you want to leave to your dependents if you were to die today? No, I'm not trying to kill you. This is just the reality. We look at these things again in those terms. If you're gone, how is that income that you have that you were providing? How is that going to be replaced? Will you require more or less insurance protection to meet their needs as time goes on? When would you like to be able to retire? What amount of income do you believe you and your spouse would need in retirement? Again, replacing that hole that you would leave behind. How much are you able to pay for your insurance program? It's all part of your budget, right? Our demands on your family budgets, other than living expenses, is going to be greater or lower as time goes on. Again, keeping these things in mind. If your children are 10, 12 years old, presumably if you have 4 or 5, let's just say you've got 2 or 3 kids, and they're ranging in age from 12 to 15, you pass away, then the expenses are going to continue on for probably the next 8 to 10 years so far as the children are concerned. So always bear that in mind. Even though they become adults, they would still be in need of financial support going through college, etc. Things, getting started in life as adults as well. So these are all things to kind of consider, to keep in mind. So there are different methods that you can use, rules of thumb, if you will. The multiple of income method needs to range between 5 and 8 times your annual income, whatever that might be. If you're earning $100,000 a year, between 500,000 and 800,000, just that simple method, if you will. The easy method, typically a family needs 70% of your salary for 7 years before they adjust to life without your income. And again, that 70% is that, for taxes, for example, the DINK, which would be the dual income, no kids method, funeral expenses plus half of the debts. So the non-working spouse method, multiply the number of years until the youngest child reaches 18 by $10,000 per year, per child, if you will, right? Family need method, more thorough because it also considers employer-provided insurance, Social Security benefits, and liquid assets. There are lots of online calculators to sort through these things, but again, that family need method is much more thorough because it considers all sources of funding, if you will, right? So there are different types of life insurance companies. Basically, there's stock life insurance companies, and the other is mutual life insurance companies. Stock life insurance companies are stockholders, owned by stockholders, and the premiums are paid out to those beneficiaries, etc. And it's run like a normal company as opposed to like a mutual life insurance company. They're much smaller, constitute about 29%. It's probably less than that now. The company itself is owned by the policyholders, and they sell participating policies, premiums, then non-participating policies, but part of the premium is refunded to the policyholder annually. This refund is called a policy dividend, so you're reaping the benefits, so to speak, if you will. Mutual life insurance companies are certainly on the decline. They used to be quite prevalent in the past, and they're less so today than they were, again, 15, 20, 30 years ago. So the types of life insurance policies, it could be, we're looking at temporary insurance or term life insurance, or renewable term policies, convertible term or decreasing term insurance. Permanent insurance would be considered such things as whole life, straight life, ordinary life, cash or value life insurance. So term life insurance, or that temporary life insurance, protects you for a specific period of time. If you stop paying your premiums, your coverage stops. Renewability option, renew the policy at the end of the term without a medical reevaluation. Again, it's all dependent upon whatever the criteria that are stated in that policy itself. Multi-year level term, popular because you pay the same premium for the life of the policy. Conversion option, you can exchange your term life policy for whole life without medical examination. Decreasing term insurance, premium stays the same, but coverage decreases as you age, or the debt is repaid if paired with mortgages, for example. Return on premium policy refunds every penny of the premiums paid if one outlives the policy term. Not very common, but again, term life insurance is set up for that very specific reason. It's going to cover a term of your life, whether it's, I think it's out to about 30 years, but typically I think it's 20 years or less. Term life policies are set up for. So whole life insurance policies are permanent life insurance, or they're straight life or cash value life or ordinary life. So you pay a specified premium as long as you live. Premium depends on your age when you start the policy, provides death benefits and also a savings account, accumulating some cash value along the way. It makes sense if you intend to keep the policy for long term, or you must be forced to save. It's another saving tool, if you will. But first consider other investment opportunities, because again, you probably won't be getting as high a rate of return through this whole life insurance. Limited payment policy, pay premiums for a stipulated period, usually 20, 30 years, or until you reach a specified age. Your policy then becomes paid up and you remain insured for life, the face value amount paid upon death. So you pay up your insurance policy, and if you outlive that, then again, you don't have to pay any more, but your beneficiaries still will benefit from that. Modified life insurance attracted people who want whole life policies but find the premiums too high to handle in their current budgets. So they typically start with lower payments and then they increase over a period of time. So other forms, variable life policy, adjustable life insurance policies, and universal life. So the variable is a minimum death benefit guaranteed, but cash value is not guaranteed. The death benefit can be greater than the minimum depending upon the earnings of the dollars invested in a separate stock, money market, or bond fund. Adjustable life insurance policy, whole life insurance policy, but you can change your coverage by changing the premium payments or the period of coverage. So you can make adjustments, if you will. Universal life gives you much more control, so it gives you more direct control. You can pay premiums at any time and almost any amount. The amount of the insurance can be changed or more easily than a traditional policy. The increase in the cash value of the policy reflects the interest earned on short-term investments, and it combines term insurance along with that investment element as well. That's the universal life. These are all different policies that are, again, oftentimes that there's some saving a tool that would be employed in this as well, some way to help save along the way, and with some cash back, some just different forms of the different type of life insurance policy available. Other types of life insurance policies, group life, that would be through typically through your employer, and their term life insurance policies. And one of the problems with the group term life policies that once you're no longer employed, then that group life insurance policy goes away. All right. Endowment life, that provides coverage from the beginning of the contract to maturity and guarantees payment for a specified sum to the insured, even if still living at the end of the endowment period. So there's a guaranteed payout, if you will. Credit life, it's paying off such things as car loans, etc. if the borrower actually dies. Expensive protection, and again, quote unquote, it's considered a rip-off. Industrial life insurance, known as home service or debt insurance, premiums collected at the insured homes, and it's the least popular. In fact, I've never actually seen this in person. No experience with it. It's something that's pretty much unknown out there, industrial life insurance policies.